Hi, this is Desmond from Global Migration Solution. Today with us, we have Scott Kelly from RAM and stands for Real Asset Management from Australia. Hi Scott, welcome, and would you like to say hi to everyone?
Hello everybody, and thanks for having me, Desmond.
Yes. So we are looking forward to share with every one of you out there about the investment for PR in Australia. So I guess this is one of the very popular programs over the years, and some of you might have heard about it. Subclass 188B, the Investor Visa, and Subclass 188C, the Significant Investor Visa. And in this session, we are going to talk a lot about these two programs. We're going to share with you the latest insight and how your investment helps towards obtaining your Australia PR. So first of all, for those who might be hearing this for the very first time, we have the Subclass 188B, the Investor Visa, which generally require you to invest Aussie dollar 2.5 million, whereas the 188C, which require to invest 5 million Aussie dollar. So with these two programs, there is a structured investment that would require you to follow through to meet the immigration's requirement, and we are going to share with you a little bit more shortly. Now, with this investment, Scots, there are certain structure, of 50%, 30%, and 20% that the applicants need to comply with the immigration's requirement. Would you like to share a little bit more with us?
Sure. So there's three levels of rules when it comes to the 188 investments. Number one, the fund manager needs to be approved under the program. Number two, each fund needs to be approved. And thirdly, the type of investments that you can invest in are somewhat predetermined by the Australian government. So in those proportions that you just mentioned, I'll just go through each of them. So 30% of the money needs to be invested in the share market. So this is listed securities in Australia that have a maximum market value of $500 million. The government calls that emerging companies. They're not really emerging because they're worth 500 million, so they're kind of emerged. Yes. They're a mid-cap, mid-range kind of securities listed in Australia. The 20% bucket is venture capital private equity. So these are private investments in companies in Australia that have a maximum asset value of $250 million. And there are also certain rules about what kind of businesses they can be. So for example, they can't be property related and they can't be lending related. And then the final bit, the rest, the so-called balancing component, the 50% of the money is invested in things like corporate bonds, bank bonds, commercial real estate and so on, not government bonds and not residential property.
Yeah, so with these three components, you mentioned about emerging company or emerging components. Obviously, with the market cap of 500 million or below, this is not a small company. But I just wanted to confirm that people might thought about investing in the Australian Stock Exchange, buying share in and out. The requirement doesn't work this way. So basically, you are engaging with fund manager or investment company like RAM. They have a portfolio of all these companies that comply with the emerging market called components, and they will be investing. So my understanding is generally in one fund, you often the time have about more than 20 counters on one particular funds, right?
Yeah, up to 45 kind of different separate investments. So it's very diversified exposure that the clients would get.
Yes, and this is good because it kind of diversified the investment into all the sectors. And in terms of the risk, this is also one of the, this is one of the way to minimize and average out the risk.
Yeah, so yes. we manage that in a couple of ways. One is we diversify very strongly. There'll probably be more than 45 companies would be exposed to. And secondly, we have a couple of different options for the client. So in each of the different areas, we have different alternatives for the client that allows them, if they're worried about risk, and many clients are worried about investing overseas for the first time, it allows them to choose a more defensive option and reduce the volatility, the risk inherent in those investments. So we have a defensive option that is very much more capital stable than the market, which means they're very unlikely to lose any money in that investment over a 4-year period. So we've been able to build these kind of products really because we have a unique situation here. We have investors who are being pushed towards investing in something that they probably wouldn't invest in otherwise.
Yes.
So we over the years of coping with that little conundrum, we built specific products in the VC component and in the emerging companies component that allows them to take that risk out if they're not comfortable.
Yeah. And I will encourage people who wanted to find out more about how RAM actually structure and manage this aspect, and please contact Scott's or RAM's office to learn about more. Now, coming back to this venture capital, and I know this has always been, the spotlight among all the three components, right?
Yeah.
So when we talk about venture capital, people always relate that to, high risk. Obviously, my standpoint is high risk, high return. But if this components of venture capital is being managed properly and it is not as scary as what you thought, and may I invite you to make some comment about this?
So again, we've got a sort of similar approach in this area. So we've got two different options for clients, but both of them give the clients an ability to reduce the risk if they're not comfortable with that. So there's no getting away from it. The underlying investments are higher risk but higher return.
Yes.
So typically they would generate returns of more than 20%. Thankfully our fund has done a bit better than that, but still the clients are worried about it. So we try and reduce the risk in a number of ways. Like, for example, in a regular private equity fund, you would be locked up for 5 years, 7 years because they're investing in startups. We don't do that. We only invest in established businesses. So businesses have already got existing revenues, existing products, existing clients. And typically they're looking to expand. That's why they need the money that we invest with them. And often they're actually already profitable. So it's not like sometimes it's translated as a startup fund. Our funds are not a startup fund. So we try and reduce the risk like that. We also have a very unique fund structure that allows the clients to see every investment and have some element of choosing those different investments. So that gives the clients a lot more comfort. And again, we have investments that diversify and spread between lots of different types of investments. So even if one doesn't go so well, overall, you've got a good chance of making good money over the period. And again, we try and walk the clients through it so they understand. And what we often find is many of these clients are entrepreneurs themselves, and many of them actually want to invest in businesses in Australia. So we just try and remind them that we can do that for them in a very sophisticated way. So rather than buying a restaurant franchise or a similar basic business, we can get exposure to IVF clinics and high-end manufacturing companies, online tutoring businesses. There's lots of different businesses we get exposed to. That's really the way that the clients should be thinking about it, because they're entrepreneurs themselves, and this is a sophisticated way of investing in businesses in Australia.
And these are the sectors that have the high, potential and for growth. And when they are joining this company or investing in this company at a later stage, and especially for example pre-IPO, and they are expecting to get a returns the moment the IPO take place. And I know in the past you have a fantastic records of even a returns of up to 20% per annum. And do you think that on average, those clients and in your portfolio for this component, what is the range of the realistic returns? Do you have that figures?
Yeah, the average return we always quote in our documents, and in our documents we always quote expected returns net of all fees. We quote a 20% figure. Historically, the returns have been higher than that, but we want to try and manage people's expectations so we can make them happy and exceed those expectations. So we've done that historically. None of the clients have ever lost money on any of the single investments ever over the period that we've been doing this. So we can point to the track record of having successfully managed through this period for the clients. The other thing, just picking up your late stage and pre-IPO. So these are the established businesses that we're talking about that typically look to expand and then list on the stock market, hence the pre-IPO. When we invest in companies like that, that's a much better fit for the visa programs, because obviously you'll be investing your money and you'll want your money out of the products by the time you're ready to apply for your PR.
Yes.
So investing for 5 or 7 years doesn't really work for these clients. So shortening up that holding period by having late stage pre-IPO is also an important feature of how we manage through the process.
Yes, and that's also one of the very important reasons, why and where I see clients choosing to invest through RAM, because the duration of the investment, doesn't go for, like what Scott had mentioned, 5 years, 7 years, rather, it could be over periods of 2 years. And, you get in, you make the returns, you get out. And let's talk about the final component, which is the balancing components. I know this is, the one that doesn't give too much of excitement, it's conservative, boring, but, you get to choose to invest into bonds and corporate bonds, bank bonds, REITs, real estate funds, or the commercial building. So I guess this is a very straightforward component, and people would just start off with some very conservative components such as bonds. And over the periods of times, how do they move from bonds, for example, into another components if they like to? What is the flexibility?
So we have 6 different funds in that area, in the balancing component, 3 bond funds and 3 commercial property funds. The bond funds start off, as you mentioned, so bank bonds issued by Aussie banks such as CBA and NAB and ANZ that you've all heard of. And then you go up a notch in terms of return, up a notch in terms of risk, so the corporate bonds, but they'll pay you about 5%. So again, a decent return. And to your point, often the clients start in those kind of investments and then they might say, okay, well, actually I feel relaxed now. I've got my visa, everything's fine. I can see the income coming through. Maybe next time I sit down with Scott and the guys, we can talk about maybe switching some of the money into the commercial property because I'd kind of like a higher yield or maybe a higher return.
Yes.
And that's perfectly, you can choose whichever one of the funds you like. You can spread the money across, you can switch between the funds, and there's no cost for doing any of that. With regard to the commercial property exposure, you mentioned the word boring. We kind of specialize in boring. So our tactics there are to invest in defensive, stable, income generative assets that are economically robust. So that means sectors such as healthcare. We've just been talking to a Malaysian institution about investing in one of our healthcare funds. So healthcare, because everyone knows about the aging population, high demand for healthcare, so good long-term leases, good long-term tenants, and not reliant upon the economic activity to drive those returns. The second sector we focus on is supermarkets. So I'm sure you've been to Australia, you've all seen Coles and Woolies. They're our kind of anchor tenants. And again, we would have them on sort of 15-year leases and have them central in a small shopping centre that has other defensive small shops around it. And then finally, the third sector, again, the clients like this, is where we have long leases to the government. So things like office towers in Canberra that lease to the government for 15 years, that have annual escalators in the leases. That means the income goes up 3% per annum. Again, this is really solid, economically robust assets that the clients can really rely on. I use that word because they generate a nice income of around about 5%, and under the program you're allowed to take out the income. So often our clients use that money to support their trips and their lifestyle in Australia, maybe pay their kids if they have kids down there. So you can take that out, so it's a good income stream and it's a very stable income stream. So the clients feel very comfortable with those kind of investments.
Yes, indeed. So we mentioned about a possible return or potential returns of 20% on venture capital, 5% on average, for example, on this balancing investment. What about the emerging components? On average, how much is the percentage of returns?
And just on the commercial property, the income, we would hope to do better than 5% with added capital appreciation of 2 or 3%. So overall return should be about 8 to 10.
Yes.
And then on the emerging companies, it's a market return. But even if you take our most volatile, the market fund that does fluctuate with the market, not the defensive one, that's generated double-digit returns, even accounting for the sell-off that we had and recovering COVID, and then a recent sell-off as we've had interest rate and inflation concerns. So even accounting for all those lumps and bumps, the clients have still got double-digit returns.
Yeah. So that explains, and these returns does explain why the changes that was made last year, July, where the Australian government removed the government bond and replaced it with this structure compliant investment is making more successful, and we have quite a positive number of clients who has already embarked on this application, and people see this giving them a much better returns and opportunity, and overall Australia has a much more stable financial markets where the investment can all be very well managed and with a stable returns. So we are very happy and we work hand in hand to equip clients with the right investment, with the right partners who actually manage their investment. And now I have question to talks about, we talk about average returns. I do have a question, and this is what also a common question from clients for myself. Often the time they would love to start investing during the visa application, because the processing time takes a while before they get the visa approved. And often the time client comes forward and say, how can I start investing? First of all, what I would like to highlight over here is you are allowed to invest during the visa application, and we do have clients who already started doing so. And how do you actually manage their investment before the approval of their visa?
Yeah.
So how do you actually go about it? Can you share with us?
So yeah, there's a couple of ways. Number one is some clients just want to go, well, I want to invest in the things that I'm going to have to invest in for my visa. So a small number of clients do that. What most clients want to do though is gradually build up their money in Australia in a secure, low-risk fund that pays them a decent level of interest, and that's liquid, so they can switch immediately when their visa comes through. So we offer our credit fund, for example, for that period. For 188 clients, we give them enhanced terms. We give them a better interest rate. So you can gradually build up your money in something like our credit fund. It'll pay almost 5% net of all fees, and then you can immediately switch that into your complying investments when the government asks you to do so. So that's a common way that people do that. So you get a good return. Clearly, you don't want to take too much risk with that money, because you don't want to park your 2.5 million and then it goes down because the market's gone down. So you want something that's very capital stable. It's not going to lose you money, but also pays you a decent level of income and is liquid when you need to switch it.
This is a good approach, because at the same time they build their relationship with RAM, build their confidence over the times, and to start off with an investment with a returns on these capital funds of 5%, I think it's a good start. And they can, like what you have mentioned, they can choose to switch over to some investment that gives them slightly higher returns as time passes. And the current processing time does take 28 months, but this morning I checked and the latest processing time indicated as 37 months. So I guess over the 37 months, for you to actually start with the investment in Aussie dollar and to build that relationship with RAMs, the confidence level before you start putting in all the investment in Australia is, perhaps a good transition.
Yeah, and then you can obviously, you have the income you can spend in Australia. We can pay it wherever you want to get paid, but you might want to use that income while you're traveling down there or for your family, and it's just a very easy way to sort of gradually build up the money.
So my last question about RAM. So we know that you are doing, or your company is doing more than just investing for the client, but do also look after the tax exposure, do also take into consideration how they pass the wealth to the next generation. So do you like to share with us a little bit more?
Sure. So the way that we describe our business is a fully independent wealth an asset management business. So asset manager is a fund manager where we can provide you with the funds for your compliant investment or otherwise. But in addition to that, when we talk about wealth management, it sounds like the same thing, but with wealth management, it's a more holistic relationship with the client. We have clients, we've been doing this for 10 years. We've had 250 clients go through the 188 process. We've got clients from 16 different countries, including 5 in Southeast Asia. So we've built up a whole series of products and services that really fit with that profile. So what I mean by that is that you need to make a compliant investment first. We'll get that done. And then you'll be thinking about whether you're going to actually live in Australia. You're going to become a tax resident in Australia. Where how do Australians shelter their money from the tax man in such a high tax jurisdiction? Can we use that? Can we use offshore jurisdictions like Singapore, for example, to reduce our Australian tax? The answer is yes. So we go through all this process with clients that can be quite daunting when you get into those kind of topics, but we've done it so many times, and I've done it personally when I moved to Australia, that we can help you through that process. We'll take you to tax advisors. They'll confirm our understanding of what you would probably, would be sensible for you to set up in Australia in terms of structures like family trusts and so on, and we can help you execute that. So we like to say we don't want clients for 4 years, we want clients for 24 years, because we can be on the journey with them and their kids. You mentioned passing on of wealth, and we can help them in a variety of ways. I mean, finally, I would just mention that we have a big lending business, a mortgage business called Brighton Home Loans, fully owned subsidiary of RAM. We do a couple of $100 million of mortgages a month actually, and one of our products lends to non-Australian borrowers. So if you have income outside of Australia, we would take that into account if you wanted to borrow money to buy a house in Australia. Other than that, it's just a regular mortgage, and if you do 2 or 3 things with us, obviously, then you get a beneficial interest rate on your mortgage. So it's just another way in which we can help you through that journey. It's much more than just simply providing you with some compliant funds.
Very interesting, Scott, and thank you for sharing. So in summary, I would like to do a summary here. So you can invest in compliant investment to get or to plan for your PR and your family's PR in Australia. But that has to be guided properly by licensed advisor like RAM. And for those who choose to invest 2.5 million under 188B, you would require or need to consider having to fulfill the 2 out of the 3 years residency in Australia, and that can be done by your spouse or yourself. For those who choose to invest under 188C, would need to invest 5 million Aussie dollar, and that gives you a much more relaxed requirements on the residency. And that comes to only on average of 40 days per year over the next 3 years. So we hope that you like what you have heard today. And if you need any support or any assistance or further information, please feel free to contact Global Migration Solutions or RAM, and we are here, to get you through and to give you the right direction. Thank you. And Scott, thanks again.
Thanks, Desmond.
Yes, and pleasure, having this chat with you.
Yeah. Thanks for having me.
Yes. Thank you all.